Good morning. This morning we're looking at an iconic Australian company. I'm wondering how many viewers will be able to identify the company just from this map. The map is the core of the company that we are looking at today. The map is the map of Bunnings stores Australia-wide, and the company that we're looking at today is the BWP Trust, which is essentially a real estate investment trust. It is the company that owns the property on which all these Bunnings stores are built. Here are the fundamentals. Not a bad price to equity ratio, paying a healthy dividend, and completely focused on the one business. Bunnings is a unique company in Australia in many ways. It has essentially established a moat around itself, beating off a competitor in the early 2010s, beating it into the dust actually. If the Australian economy is rising or falling, one company where you can expect to see that generally reflected is Bunnings. Here are the financials. The word obviously is consistent. Earnings aren't always growing, but they're remarkably consistent. Investment seems to be very reliably growing. And here are the dividends. My test for what can be called a dividend company is a company which consistently pays a dividend higher than you're going to get as an interest rate in a long-term investment in the bank, which is the obvious comparison. I cut that off at 5%, paid consistently over a period of at least 3 years. On that criteria, Bunnings doesn't qualify as a dividend stock, but it certainly comes very close. And here's a long-term chart. The company was created back in 1998. Where you draw these lines is always somewhat arbitrary. You can assess where this line is drawn according to your own judgment, but there's no denying the company has a very strong history of consistent growth. What you do see is that fairly obviously the channel between the highs and lows of this consistent growth seems to have been broken around here when the company at about this point failed to return to growth up towards $4 and dropped below the $3.50 mark, and it's now at $3.34. This is the basis for what I am suggesting to you is an opportunity. Here you have the chart showing the progress of the stock's price since it peaked after COVID. The company recovered very comfortably after COVID and peaked, obviously because for most of us there was very little option in terms of occupation apart from pottering around in the back garden or in the back shed, or tending your indoor plants. COVID and Bunnings were made for each other. The company obviously retraced from that peak, although it's interesting to note that the company had reached $4.20 before COVID, and this is what's interesting about the subsequent price action. because what you see is that there was a steady retracement down below $4.20 through to the end of 2022, and then the company has encountered a year of falling price in 2023, started to recover last year, but has now fallen, as I say, right through the bottom of the growth channel. And this is the premise for this video. Do we think Bunnings is going to continue to fall in price? Of course, BWP isn't Bunnings. BWP is a company very closely associated with Bunnings. We might surmise that the performance of BWP is really a function of management decisions that are made at Wesfarmers, which owns Bunnings, in terms of whether or not the profit base of the Bunnings brand is going to be translated into profits for the shareholders of BWP. Going back to this long-term chart of growth, I'm suggesting that it is a pretty fair bet that both the board of Wesfarmers and the board of BWP are going to ensure that the market confidence in BWP is renewed and ensured, and given that they're essentially a monopoly and given that they are essentially tied to each other, it is a situation which is remarkably within the control of the boards of those two companies. The particular reason that I wanted to talk about BWP today is that part of the whole rationale behind BuyPoint ASX is the focus on the MACD, moving average, convergence, divergence. This is not an exact tool. It is simply, on the basis of my analysis and my research, the single most reliable tool for predicting when a stock is going to go up in price. And that point is a buy point, which I identify, and everyone can read these charts differently, as the point at which, just here, you can see that the longer term moving average line, the blue line, is about to intersect the shorter term moving average line, the orange line, in an upward direction. So that was a buy point right there in early November. What we can see from the chart is that this buy point did not result in significant growth. And the reason that I've chosen this example today is because what I've observed since I started looking at MACD as a primary indicator of when to buy a stock is this pattern, where essentially what's happening is you can see that the MACD is taking a run up to growth. Here was a buy point, it stalled out. Here's another buy point, it's at a lower price. The price has moved sideways, and again, the growth that follows this buy point stalls out. Then we have this sideways movement, and here we are again at another buy point. The suggestion is that this sort of run-up pattern is one that we can see duplicated in the past. You can look at the MACD and draw your own assessments, but my suggestion is that if you're going to buy BWP Trust, Today is the day to do it.